Hi, everybody. My name is David Gully. I'm from Bentley University, and this is the second of a two-part series on the labor market. Please visit our YouTube channel, Bentley University EC391, for some really cool videos on monetary policy and the macroeconomy. So in part one, we looked at various measures of the labor market in terms of how you can measure the conditions. We looked at the unemployment rate, the labor force participation rate, and many others. We also looked at factors that impacted both supply and demand for workers pre and post pandemic, and therefore, by implication, how wages are determined. So here in part two, we're going to look at what are known as labor market dynamics. So first, we'll take a look at job matching. That's how quickly and efficiently workers and firms find each other. The Great Resignation, that's of course received a great deal of media attention. And then finally, we'll take a look at factors that are having some longer term impacts on the job market. So since the pandemic, there have been many changes to the labor market. It's hard to know whether or not, however, these are permanent or relatively temporary. Even still, there's a good chance that there's some very strong implications for monetary policy in terms of how the Fed looks at the labor market and whether or not it's generating inflation, and then longer term economic growth. So let's take a look at three standard measures of the labor market. So first, we'll look at the U3 unemployment rate. This is the most common measure of the labor market tightness or weakness, as the case may be, that gets reported in the media. And the way this is measured is you take the number of people who are unemployed divided by the number of people who are unemployed plus the number of people who are employed. So the denominator is the size of the civilian labor force. And then the numerator, of course, is just the number of people unemployed. But to be unemployed, you have to have looked for work at least once in the last 4 weeks. And you can see that pre-pandemic, the unemployment rate reached a low of about 3.5%, coming down from a peak of 10% during the worst of the Great Recession, reached a maximum rate of 14.7% right during the worst of the pandemic, and has bounced back relatively quickly, again, relative to previous situations where the unemployment rate risen and has only slowly come down. And you can see here that the unemployment rate has reached now pre-pandemic levels. In terms of the level of employment, you can see that there's a strong upward trend pre-pandemic. The economy closed down during the very beginning of the pandemic in March and April, started bouncing back in May 2020. And you can see, again, relatively speaking, a strong recovery. And we've recently moved back above the level of peak employment that we saw in February 2020. And then finally, the labor force participation rate. This is the number of people who are employed plus the number of people who are unemployed. So in other words, this is the denominator of the unemployment rate divided by the civilian non-institutional population. So it's the labor force relative to the size of the population. And you can see there was a downward trend here pre-pandemic, reached a stable level of about 63%, give or take, and then fell very dramatically right at the very beginning of the pandemic, March and April 2020. It bounced back relatively quickly, but notice here it's stagnated. And so we're over a percentage point down from our previous level of just over 63%. And that translates into many, many workers who are still not yet returned to the labor force. And so if we just look at these data, in terms of the unemployment and employment levels, those look to have returned to pre-pandemic levels, but not so much labor supply. But it turns out there's a lot more to the story here. As we've noted, there are a lot of changes in the labor market. And what we mean by this is people just didn't go back to their old jobs. A lot of people switched jobs. A lot of people switched careers even for any number of reasons. And so what we want to do here, this is kind of a segue into looking at what's called job matching. So how well do firms and employees find each other? So for example, if this process is super efficient, that'll pull the unemployment rate down. Fewer people are looking for work because they find work more quickly. the level of employment rises. Wages rise because workers are matched into their best jobs where they can use their skills and resources to their maximum ability. And then job openings fall because if the matching process is efficient, any opening is filled relatively quickly. Well, if it's not so efficient, all those good things turn out in reverse. And so what's happened to the job matching rate here recently? So let's think of some of the factors that go into that in terms of how well does this work. A lot of it involves availability of information. Do workers and firms know about each other? Do workers know about vacancies? And do firms know about available workers? What about structural changes in the jobs being offered versus the skills available? This could be problematic if there's lots of jobs available, but the workers who potentially might fill those jobs don't have the requisite skills or experience. Also, what about preferences versus employers and employees for example, say remote work? If there's a matching preference, the job matching rate will be relatively high. If there's differences in preference, then the job matching rate will be relatively low. And so first, let's take a look at separation rates in terms of people quitting and potentially moving from one job or industry to another. And so an interesting study looked at and calculated by industry, by all these industries here, the average separation rates for the 10 years pre-pandemic. So that's the blue right here. But then compared that to the maximum separation rate during the sort of the peak of the Great Resignation, so to speak, in 2020. And so you can see that across all industries, the 2020 separation rate was substantially higher. And for some industries, like education, retail, various service industries, hotel and restaurants, the travel and leisure industry, and arts and entertainment, the separation rates were dramatically higher. So lots and lots of people were separating, leaving their particular job. The question is, well, where were they going? Were they matching into other jobs? And so the question is, well, how efficiently are people moving from one job to the next? So what's the efficiency rate or the matching rate? And there's been a number of studies looking at this. And so from the Minneapolis Fed, a education reporter had one of the authors of one of these papers, Simon Mange right here, update information pre versus post-pandemic. And so here over on the left, we can see this is the period, this gray area here, that's the period of the worst of the pandemic. And the two lines there, one adjusting for the employed and workers out of the labor force, because there's some difficulties there in terms of sorting out moving from being unemployed to employed or being out of the labor force to being employed. But the point is that if we have 0 as the baseline pre-pandemic, then the matching rate by either measure has approached roughly to its pre-COVID peak. And so initially at the very beginning of the pandemic, the matching process, workers and firms finding each other, declined very dramatically, but has in the aggregate, for the most part, bounced back. Some more data here in terms of job openings versus hires. This is another way to look at it. So the solid red line, this is the number of job openings. So you can see that skyrocketed very dramatically post-pandemic. The idea, and this gets across in the media, of course, is that firms are desperate for workers. So relatively high rate of job openings or level of job openings. But then here, the dotted line right there, that's hires. So hires increased, but not nearly in proportion to the number of job openings. And then likewise, here's separations. You can see they picked up somewhat post-pandemic. Of course, they skyrocketed during the pandemic right there, but they're still not out of ordinary in terms of pre-pandemic. So now let's take a look at what's called the Beveridge curve. And so this graphs the vacancy rate on the vertical axis against the unemployment rate on the horizontal axis. And the Beveridge curve under normal circumstances has a downward slope. In other words, a very low unemployment rate ought to be correlated with more vacancies. So if a lot of firms are hiring, it should take them a long time to hire somebody and fill a vacancy. So a given vacancy will last for a while, and there should be lots of them. On the other hand, suppose the unemployment rate is very high. Well, if this is the case, there should be very few vacancies. First, very few firms are hiring, so there's not many vacancies in the first place. And then any vacancies that do exist are very quickly filled because there's lots of potential workers to fill those very few vacancies. And the idea is, and we'll see a visual in this here in a second, is if this curve shifts, then that can indicate changes in job market matching. And so here we have the Beveridge curve. This is from the Bureau of Labor Statistics and their JOLTS data, the Job Openings and Labor Turnover Survey. And so let's unpack this here a little bit. So there's a lot, looks like there's a lot of stuff on here and a lot of squiggly lines. But what we can do is we can isolate these for various time periods. So roughly speaking, if we graph out this Beveridge curve right here, that is pre-Great Recession. So this is roughly from the early 2000s to just before the Great Recession. Then post-Great Recession, this is the gray right here. This is post-Great Recession Beveridge curve. And so notice, we haven't gotten to the pandemic yet, but there was a shift from the pre-Great Recession Beveridge curve to the post-Great Recession Beveridge curve. In other words, for a given unemployment rate, say 6%, just to pick one at random, for a given unemployment rate, there are now more vacancies relative to the situation pre-Great Recession. So the matching, the story there would be the matching efficiency didn't work quite as well. Then we have, of course, the pandemic. And so right here we have the Beveridge curve that only has 2 points. So these are March and April 2020. And then post-pandemic, we have this Beveridge curve, not quite as clean and neat, but still follows the same general pattern. You know, again, post-pandemic. And these observations over here, right around the lowest unemployment rate, those are the most recent observations. And the unemployment rate, excuse me, the vacancy rate is starting to fall. And so as a consequence, and then, excuse me, the job openings rate is starting to fall. And so the Beveridge curve might starting to be sloping downward a little bit. And so what this looks like is because there are so many openings, so many vacancies for a given unemployment rate. So notice how dramatically the Beveridge curve is shifted upward. That says, oh, matching is terribly inefficient. But go back to our previous charts there, the matching efficiency rate is now reached its pre-pandemic norm, or pretty close to it. And so is there something else going on here where the Beveridge curve isn't necessarily capturing matching issues? So again, the standard story is the Beveridge curve would shift up like we just showed because job matching has declined. Now, this can be very frequently true, so we don't want to, dismiss that out of hand. But it turns out the Beveridge curve can move for reasons that don't really have very much to do with matching efficiency. So consider, for example, a super large increase in the demand for labor. In other words, this will generate a very big increase in vacancies with very little change in the unemployment rate. And so something like this would occur with a already relatively tight labor market, a relatively low unemployment rate, where suddenly lots of firms want to hire a lot more workers. This doesn't mean the matching efficiency has declined. There are just relatively fewer workers to potentially match into those very high demand jobs. And what's also important to note here is that vacancies, think of how vacancies can be filled. Well, clearly the obvious thing you would think of would be, gosh, vacancies can be filled by people who are unemployed, right? That's the idea of the Beveridge curve. How is the number of vacancies related to the level of the number of unemployed? But here's the thing to keep in mind. Think of also how a job could be filled. It could be filled by somebody who's already working at another job. In other words, they're poached from another employer. Or alternatively, somebody could take a job, fill a job, a vacancy, who was previously out of the labor force. They weren't measured in the U3 unemployment data. They were unemployed, or excuse me, they did not have a job, but they were not looking. Once that happens, not having a job and not looking, that person moves out of the labor force. And so some people transition from moving out of the labor force altogether to being employed. So these two factors here, these really aren't captured by a standard Beveridge curve. So here's some visuals. So the key thing to keep in mind here is, I emphasized in the previous slide, is that sometimes job openings are filled by people who already have an existing job. And so we've got a study here that looks at, well, the number of vacancies that are filled by job jumpers. In other words, people who move from one job to the next. And so you can see here, in terms of solid red line, those are the postings for people who are being, sort of recruited, who are already working. They're not necessarily, or excuse me, they're not being recruited from people who are being unemployed. So the idea is that firms are not looking for unemployed workers. They're looking for employed workers, perhaps at, for example, competitor firms. So again, those kinds of dynamics aren't really well captured by the Beveridge curve. So let's turn to the Great Resignation. Now, of course, this has been in the news recently. We've all heard talks and stories, and perhaps know people who have quit their jobs to move to something else that they much prefer. And so what we've done here is we've graphed out the monthly level of quits, seasonally adjusted, from the early 2000s through late 2022. And so you can see here that during the very beginning of the pandemic, relatively few people quit their jobs. Lots of people were laid off, of course, but relatively few people quit. But then suddenly, as the economy opened back up, quits skyrocketed, well above their previous pre-pandemic level. But what we want to note here is that if you follow the trend here, we are now pretty much back on trend. So we had a period right here above trend, but notice how quickly that's reverted to trend. So the point here is that certainly lots of people quit their jobs, but relative to recent trends, now part of this, of course, is going to be driven by the fact that the size of the labor force has generally increased. Keep in mind, however, that this bump right here might understate things a little bit because the size of the labor force is actually declined. Think back to our labor force participation graph that we had up there earlier, a lower labor force participation relative to a higher quit rate or level of quits. And so that implies perhaps this jump here maybe perhaps understates things a little bit. But the key thing is that there had been an upward trend in the level of quits even pre-pandemic. And it wasn't just a little upward trend, it was a very solid upward trend that had been going on for about a decade. What we can do is break this down, thanks to Bauer and some associates, broke the quits down by various industries. And so this is the quits rate. So this is not the level, this is the quits rate. And so here is the equivalent of the graph we just had up there earlier. And you can see over on the right here, there's the Great Resignation increase in the quits rate. But notice that across various industries, there's dramatic variation in the level and the level of change in the quits rate. So let's take a look at the one extreme case here to illustrate the point. Government. Very few people quit government jobs in general, and there was only a very modest increase in the quits rate in government employees. However, looking at kind of the other extreme, leisure and hospitality, hotels, restaurants, etc. The quits rate is notably higher turnover in general in that industry. And then notice that the quits rate increased pretty dramatically post-Great Recession. Likewise, there was a dramatic increase in retail trade, and also with retail trade, notice the relatively high level of the quits rate compared to, for example, government and others. And so the point here is that there's variation, dramatic variation across industries in terms of the level of the quits rates and also how much those rates have changed pre versus post-pandemic. And so how tight really is the labor market? Well, one very common measure to evaluate this is to look at how many unemployed people there are relative to the number of job openings. So if you just take the number of unemployed people and divide it by job openings, that gives you a quick and dirty indicator of, well, gee, how tight is the labor market? And so you can see that in a recession, there's lots of unemployed people relative to each job opening. As the economy recovered, that ratio declines. It, of course, skyrocketed during the pandemic, but notice it never got nearly as high as it was post-Great Recession. And then here we are, post-pandemic, that ratio has declined to all-time record lows, well below 1. In other words, fewer than one person, unemployed person, per job opening. But the key here is to keep in mind that the numerator is unemployed, the number of unemployed people, and that includes or only includes people who are not working and who are looking for work. And so as a consequence, this ratio has some limits, because what happens is sometimes people move from being out of the labor force altogether directly to being employed within a 1 month sample period. So they never get defined as, they never get measured as or counted as being unemployed. They transition very quickly from being out of the labor force to being employed. And so the idea here is that there's a whole pool of workers out there who are not well captured by labor surveys, who have the potential and who may be available to work. And so what this chart here measures, labor force flows not in the labor force to being employed. And so notice there's been an upward trend here from people being out of the labor force to being directly employed. So these sorts of transitions are very important for job filling, and also in terms of, well, how much slack is out there in the labor market. Because if there's a lot of people who are not in the labor force who are willing to work, that means measures of slack that include unemployment don't accurately capture the true level of slack in the labor market. So now let's turn to some longer term impacts that are being felt in the labor market by a whole number of interesting dynamics. And so we'll go through all these one at a time. And so these factors are having impacts on the labor market and thus on the overall economy, and therefore will have an impact on monetary policy and long-run economic growth. So again, let's go through these one at a time. So from my perspective, one of the most important factors going forward here is the level of enrollment in higher education. And so if you look here, this is all sectors. Relative to 2018, each year have seen a decrease in the level of enrollments. However, there's variation across different sectors within higher education. Most notably, at community and junior colleges, two-year schools have seen the largest, by far, the largest declines in enrollment. Still a large but much smaller decline in enrollment for public four-year schools. And then private nonprofit 4 years have seen some of the least impacts. So going back here, we have far fewer people enrolling in community colleges. Part of this could be people who are seeing a strong labor market right now, and instead of going to school, going to a two-year school and getting an associate's degree, they join the labor force. You know, the growth in wages, the readily available employment, etc. If they are just delaying their enrollment in college, that's one thing. But if they're permanently not going to school, this reduces their educational attainment and perhaps has longer run impacts on their career development and their career advancement, and therefore how their wages grow over time. So it'll be interesting to see if this reverses itself or if this is a more permanent and long-lasting feature. as a consequence to being or to seeing a very tight labor market, companies have changed their requirements in terms of their expected level of education. And so this chart here from the Wall Street Journal, and then directly from or indirectly from Burning Glass, looks at the percentage of postings that require at least a 4-year college degree. And notice the sharp decline. Now, granted, there's certainly been some bounce back, but the sharp decline in the job openings that require a college degree. Part of this could be the nature of jobs that are being advertised for. For example, entry-level retail, service jobs, things like this, generally don't require a 4-year degree. So if there are more of those jobs being offered, then that indicates that lower skilled, lower educational attainment is not so much of a barrier to entry. Or firms could be also reevaluating their jobs in a very tight labor market and saying, gosh, do we really need somebody with a 4-year degree? Is it possible that somebody with an associate's degree or a high school degree would be able to do these jobs? And so the tight labor market is causing a rethink. Test scores for students in K-12. So we all know that Zoom education is not exactly a perfect substitute for in-person education. And this is seen in terms of standardized test scores. And so what I've done here, this is from US News and World Report, is I chose math tests for 8th graders. And so the way you interpret this is that if blue is a gain in test scores from 2019 to 2022, if it's red, it's a decline in test scores from 2019 to 2022. So you can see the entire United States, all 50 states are red, and the deeper the shade of red, the larger decline. Now, what's important here is that there's a lot of variation even within a state. Students in relatively high income public schools have seen smaller changes. And so these test score declines are not evenly distributed across countries or across states, or even within a state. The important thing to keep in mind here is that lower test scores, lower math test scores, are correlated with lower educational attainment in terms of likelihood of graduating high school, likelihood of graduating with an associate's degree, likelihood of graduating with a 4-year degree. And that's therefore also correlated with wage growth over their life. And so what we all hope here is that from, say, 8th grade over the next 4 years through graduating high school, is that teachers can, at least to most extent, reverse these declines in test scores. Students with low test scores are also more likely to drop out. And so as a consequence, this is really worrying. So we hope that throughout the nation that students can get caught up, at least to some extent. Long term, if they don't, this is going to really, really impact the labor market and individual students going forward throughout their lives. Work from home. We've all heard the stories about people who have changed jobs and gone completely remote. They moved from a major city, perhaps San Francisco in the tech industry, and now they live in the wilds of Oregon somewhere because they have a really solid internet connection and they can do their job from more or less anywhere. And so you can see here is that this is scaled from light blue to very dark blue, almost purple. The darker the color, the more the share of working from home people have increased. So you can see it's blue in every state of the union, some more than others, of course. The problem, or not the problem necessarily, but the issue is, well, how permanent is this? Well, we'll see here. It turns out there's perhaps a mismatch of preferences. So this is from a Washington Post article recently in terms of preferences for workers who want work from home jobs versus preferences of employers posting work from home jobs. So these are the share of applications going to work from home jobs. These are the share of postings that are offering work from home jobs. And so you can see some disagreement in terms of what firms want and what workers want. And so it'll be interesting to see, well, how does this situation resolve itself? Do firms sort of bow and take the preferences of workers into account or potential workers, or do firms stand firm and workers end up coming back? Again, that remains to be seen. Another longer-term trend is the automation of lower skilled jobs. Workers in retail, manufacturing, and so forth are very scarce, and as wages grow, that gives lots of companies a very strong incentive to figure out if they can do a job with some form of automation versus using a person directly. And what automation in general tends to do is it's more likely to displace low-skilled and entry-level workers. And so there's lots and lots of examples here. Self-driving cars are under development. They might be years away from being effectively rolled out, but they are coming at some point. Related to that, delivery and transport, self-driving trucks, for example. In manufacturing, robots, to use the old standby example, and then customer service. And customer service could be AI customer service agents on the phone. Customer service could be serving customers in a restaurant. McDonald's and Taco Bell and others are prototyping highly automated restaurants that use far fewer workers than the standard Taco Bell or the standard McDonald's. And so a recent study took a look at the share of jobs being at risk over the next 10 years, both by region and by industry. So we'll focus over here on the left. North America, in general, has the highest potential of jobs or share of jobs that might be automated away. Now, when we say automated away, we mean entry-level jobs. Some entry-level jobs are being reduced, but other types of jobs, programming, manufacturing, for example, other types of jobs could very well be increased. So it's not necessarily a total decline in jobs, but it's certainly a structural shift in the types of jobs that will be created. And so you can see there's quite a bit of variation. So in transport and logistics, again, self-driving cars, trucks, and so forth, many of those jobs could potentially be automated away. And even across lots of other sectors, a large fraction of jobs could be potentially automated away, either by robots or some other mechanical means, or by artificial intelligence. Another trend is a change in the labor force participation rate. And one of the most notable ones is non-college men. In other words, men who have not graduated college, either have some college, high school degree, or not a high school degree, is that over time, relative to the earnings of other age groups, earnings of non-college men have declined notably relative to other groups. And then over here on the right, exit rates out of the labor force have increased very dramatically relative to college, men who have graduated college. And so over time, these non-college men, who have not graduated college, are seeing their wages erode and are therefore moving out of the labor force. And this is not just a few people, this is hundreds and hundreds of thousands of men who are moving out of the labor force, and if they do not return, will be permanently left behind. And given the scale of this, this is an important development in the overall labor market. And so in summary, in general, the labor market is still very tight by most measures, but as we saw, openings, for example, job openings have declined somewhat. Now, the Fed's current policy actions, raising the federal funds rate, shrinking the balance sheet, and using forward guidance, all of these are intended to reduce labor demand. In other words, make the labor market less tight. What they're trying to do is do as little damage as possible to the level of employment. And as we noted in the previous part one of this series, that's really pretty difficult to do. We still, however, have not reached what's might be called a steady state. In other words, an equilibrium in terms of, for example, the share of jobs that are work from home. Whether or not there are the labor supply changes we talked about are going to be permanent? Will the labor demand composition remain? Because we've shifted away from certain types of jobs, again, for example, work from home types, to, or out of the office and to work from home. How permanent are those kinds of changes? We don't know yet, because we're only just not even 3 years post-pandemic, and a lot of these factors will take a while to work out. All right, thank you all, everybody, for listening.